Dollar yen at 93.82. We continue to see dramatically stronger yen, perhaps off Mansur Muhyiddin's UBS report, really reiterating strong yen. A long wait till the Fed raises interest rates. Robert Dahl joins us now, Vice Chairman, Global Chief Investment Officer at BlackRock. Bob, good morning.
Good morning.
What's the new actuarial assumption when you walk into BlackRock every day and you say equities, bonds, allocation, prudent portfolio? What's the new handle you put on it? Is it 7%? Is it 9%? Where's Bob Dahl?
Yeah, we're in the 7 to 8% zone. We think that earnings growth over the longer term for the S&P can be almost that much, a little lower for the domestic portion of the S&P, a little higher for outside, put a little dividend growth on top of that. And we get a 7-ish kind of number, not so bad with inflation not far from zero.
Well, maybe you get a good real return there, but that's a long way from the comfort of double-digit numbers that we knew decades ago. Do we ever get back to like a 12% equity return blended out over 3, 4, 5 years? Is that ancient history?
Yeah, I think 12% over a 5-year period is probably a tough number to come by. We'd need a faster nominal growth rate, that is real plus inflation, to have a shot at 12. I don't see that anytime real soon.
Bob, we have both Warren Buffett and PIMCO saying essentially the same thing. Buffett in the Times and PIMCO on its website that essentially the government spent too much money, and that's going to be a problem for both the dollar and the U.S. economy. Are you pretty much in that camp too? And if so, what are you doing about it?
Yeah, afraid so. I think that growth would probably be a little higher in the longer term if those things weren't true. They're nooses around our neck. They're wind in our face. I think what you have to do, therefore, is be a little more prudent about what kind of expectations you have for domestic growth. Therefore, having a little more money outside the United States, not just directly, but also owning companies in the U.S. that have multinational exposure, are ways to mitigate against those issues.
When you see, Bob, a target here from you of over 1,000 on S&P, right now, folks, S&P 989.67. I mean, you've had a real run here from March. Do you raise more cash? Do you move to corporate bonds more? I mean, when you come off that bottom move that we've had, what do you do within a long-only buy-side framework?
Well, we've had a 1,000 to 1050 target since the first of the year, obviously looking wildly bullish not too many months ago. The calls now we're getting, are you going to take your target up? We're not. The higher end of that range, 1050, is kind of 50 points away. That's 10 a month. That's 1%. I'd settle for that. Wish it could be a straight line. So I agree with you. I think not only did you want to take a little money off the table, but more importantly, inside your equity portfolio, I think you want a little higher quality, a little more predictability, maybe take a little of the edge off the cyclicals. They'll come back, but I think they pause first.
Yeah, I did it quickly here, Bob, on the Bloomberg. I mean, off the March bottom, we're up 46%, call it, maybe 47%. Bob Dahl's a genius. You want to go to your target up 6%. Is that worth I mean, how do you handle a broad portfolio if you're only trying to make 6% to get to the end of the year?
Well, our first of all, 6% for the end of the year is almost 20% annualized.
Good
that's
point.
A pretty sweet number.
Yeah, that's good
Number
point.
one. Number two, we don't think 1050 is the end of the bull market. We may have a pause before we even get to 1050. I think we will.
Bob Dahl just said it's a sweet number. I like that. I mean,
yeah.
That, it's a sweet number.
Well, Bob, we have John Deere in this morning, just the latest company to come in with earnings that beat Wall Street's target, and yet sales, left a little to be desired. When can you see sales picking up? I mean, this kind of news we heard from Deere has been sort of the theme of the second quarter.
Sure has, Ken. It's been a very common theme. If you go back to earlier recessions, you find that theme always starts things out. That is, earnings are less bad, then they turn okay, but it's all about cost cutting. Finally, the revenues come in. Our guess is starting this quarter, third quarter into the fourth quarter, we will have positive real and nominal GDP permitting some revenue growth. It won't be enough to jump up and down about, but it'll be a big change from the kind of reports you just referenced.
So then the recession's over and everything's going to be fine.
Well, the recession we think is ending, absolutely. Everything just fine. It's never that simple. We, as you remember, had a credit earthquake, and my guess is there's some aftershocks that we'll feel from time to time, but in the main, we think it's safe to put your toe back in the water.
Well, Tom introduced a new word the other day, the V-shapers. You know, people who think the economy is going to bounce right back.
Full credit. Dominique Constantine, Credit Suisse came up with that.
Well, you passed it on. Anyway, the chart, Tom loves charts, as we all know, is going to look like a letter V. Are you a V-shaper, or are you looking for something else?
No, I think a V implies a normal recovery, I think, what most people mean by that. Normal recovery has real GDP almost 7% for the first 3 quarters on average outside of a deep recession. We don't see it that strong, maybe half that. So I think that we can't get carried away with the upside because of the headwinds of continued deleveraging, paying down debt, and the rest. Having said that, for the bulls, we have the bad news in terms of declining GDP behind us. So up, but just not the same magnitude.
Bob, we want to have you back here. Let's squeeze it in here a little more. Are we going to get the corporate earnings to generate that up 6% on SPX? I mean, where are we right now in the state of third and fourth quarter corporate earnings?
Yeah, third and fourth quarter earnings, our guess is we'll have a chance of surprising to the upside. Expectations are not real high. Compares, as you know, start getting easier. And most importantly, it's not just going to be cost cutting. We'll actually see some revenue growth. And I think that will give some people cause for at least a sigh of relief, if not for some optimism.
You know, Bob Dahl with us is going to be back with us in our next block as well. Bob Dahl and I are raising the flag here for the Cfa exam grades out yesterday. We welcome all of you worldwide that took those painful exams. 46% pass rate, Ken, for level 1. Oops, level 2, 41% and 49% for level 3. What that means is a lot of marriages were ruined as everybody took the CFA exam. We congratulate all that passed the CFA Institute's various and sundry exams. I think it's important there what Bob Dahl said about, you know, you look at, you know, quarterly numbers up 6% over 2 quarters, but, you know, when you work that out, it's 18% or so annualized. You got to remember, you know, you look at it over an annual return, not bad. And where was a lot of people, of course, in the March lows? We heard that from Abby Joseph Cohen earlier this week as well. And
again, we have word from John Deere. That's the latest big company to report earnings. It came in better than Wall Street expected. Deere up about 17% so far this year, and one thing it has going for it is generally rising commodities prices, including agricultural commodities. So when the Farm Belt makes money, they tend to buy new tractors and combines and all of that.
Yeah, John emails in FSI Capital. He passed level 3. Congratulations on getting a CFA. John, we're going to have much more with Bob Dahl. We're Quinn, thanks so much. Folks, Bloomberg Surveillance were brought to you by Town Motors Audi. I just went out on Twitter on a question I want to ask Bob Dahl about R-squared. We'll get to that in a second. Folks, find us on Twitter, Tom Keene _. Also on Facebook under Bloomberg Surveillance. And Ken Pruitt, Digital Guru, even has his own Facebook page. Did you know that, Ken?
Didn't we have that story yesterday that what percentage of...
85%.
I think it was 40%, actually, surprisingly low is what was the phrase? Useless babble?
Something like that. We're doing
except
a lot
for what Tom does.
Yes, of course, what we're doing. Bob Dahl with us from BlackRock, their vice chairman. Bob, my question to you is on a portfolio basis, are you managing tighter to the benchmark or away there? That's statistically R-squared. Are you trying to match a given benchmark as you come out of this turmoil, or do you try to get more, let's say, ad hoc or more free form?
Because the market volatility intra-market volatility is so high, you make a few bets and all of a sudden you've got a lot of deviation from your benchmark. Our goal, of course, is to beat our benchmarks, and to do that, right now, we think the question is the cyclical versus quality question. And while cyclicals have run, we think there's a chance quality has a bit of a catch-up move here. So the deviations we're making from benchmark at the moment.
Bob, what's your reading on healthcare reform and its impact on pharmaceuticals and managed care and all the other stocks related to that?
The line I've been using, Ken, is healthcare reform is a gray, not a black cloud for the healthcare industry. And the market for a while was assuming the black cloud. We all know with the last few weeks, the bill has been watered down and moved to the right. We expect there will be health care reform legislation. The president desperately wants it and will sign almost anything. The politics between here and there we could speculate on, but our guess is it won't be nearly as onerous for that industry as previous thought. We actually like health care. We think it's a good risk reward.
Now, we were reporting the other day that Warren Buffett is loaded up on Becton Dickinson, which makes medical equipment. Is that where we want to be, or do we want to be somewhere else?
I would not fight the Becton Dickinson idea. Prefer the healthcare services name, some of the HMOs, United Healthcare, WellPoint, Aetna, that package. In biotech, Amgen, which is pretty cheap. Yes, they've got some patent issues, but some new product issues on the other side. Pharmaceutical space, we're about to have 4 major pharmaceuticals become 2. We want to own that package. A lot of cost cutting going to come there. Wyeth is a name that would fit the bill in that category.
So for pharmaceuticals, you pretty much like everything, right? The big ones and the smaller generic ones.
Particularly the ones that are in the process of merging, because we think cost cutting will be an important feature to the earnings growth in pharmaceuticals.
And Bob, just in a little bit of time we've got left with you here, the cost cutting, are we going to see that again third quarter and fourth quarter in corporate earnings?
I think we will. I think that it'll be at a minimum lagged effects from what was happening during the second quarter. Anything cut during the second quarter has a full effect in the third. So it will be a feature. But as we talked about in the earlier segment, we also need and want to see some improvement in the top line. That's what the market needs. For it to go up from here, it can't just be less bad news and cost cutting. We need to see some good news.
Bob Dahl, the Global Chief Investment Officer at BlackRock.